And thank you everyone for joining us and for the opportunity to speak and give some ideas and some thoughts around taxes today. I think there'll be plenty here for everybody from a tax law perspective. So hopefully you're walking away with something good. I know we're on the lunch hour now, at least here in Nashville where I am. We're over lunch, so grab your soup or your salad or your sandwich and kick back. We'll do a little tax talk for the next hour here. When we conceive of this program, when we're getting Catalyst together and we're highlighting a piece for taxes, of course, we don't exactly know what it is that we're going to be getting. Let's move back here. So we put the program together a couple of months ago, and we wanted to make sure we left a space in there for talking about the latest in tax legislation, but we don't always know how far that tax legislation is going to get or what we're going to have to talk about. We've definitely got some things to talk about here today, but we don't have a bill that's finalized and ready to go with actual law changes in place. So we're going to start today with what do we have? Where are we today? We're going to work through what the path for tax legislation looks like, where we go from today to the point that we actually get a bill that we can dissect and start to plan for. And then we're going to dive into what proposals we have from a business tax side, from individual tax side, estate planning, et cetera. What's on the table today? What can we start thinking about? What can we start planning for? And then we'll close up with how to actually get started with some planning. How should we approach certain things? I skipped over there just for a second, who I am and what I do. So just briefly, I'm Blake Harrison. I work in the tax department here at LBMC, specifically in the wealth advisory practice. I spend most of my days advising clients on planning for income taxes and estate taxes. And I've done that both here in Nashville for the last 6 years, as well as in Washington, D.C., in Northeast Ohio and New York City for a number of years. Before figuring out that Nashville was absolutely the best place in the world to live. So let's get started. Let's look at what we have and start with a where are we today? So I mentioned, and I want to reiterate, and we'll probably do so a number of times during our talk today, that none of the information that we have right now, none of the proposals that we're going to talk about are actually set into law yet. What we have is a proposal from the House of Representatives. Congressman Neal is the head of the House Ways and Means Committee. That's who writes tax law in the House of Representatives. We have 881 pages released on September 13th that proposes over 40 different tax increases. These are pay-for items that go with the Build Back Better reconciliation bill, okay? So the Build Back Better Act is a proposed piece of legislation that's the result of the budget reconciliation process. So that's a tool used by Congress in order to avoid the filibuster in the Senate. So using the budget reconciliation process, they're able to pass a law with just a simple majority, or in the case of what we expect, 50 votes from the Democrats in the Senate, plus the vice president's tie-breaking vote. It does not get subject to the filibuster, which requires 60 votes in the Senate to close debate and move on to a vote. So the reconciliation process comes with its own set of rules, but that's what we're looking at here. So the path to this bill passing is 50 votes in the Senate through reconciliation. So what it says, we have proposed law changes that help fund the Build Back Better Act, which is a kind of a broad bill. It has a lot of the campaign proposals that the Biden administration put in place when they were campaigning, or through the Green Book, which is tax and budget items that they put out earlier this year. It follows a lot of the things that have been talked about through those processes, with some differences. And we'll highlight some of the differences here, both in amounts and in strategies as we come up. Something that's important to remember as we talk through what we have here: there is no proposal out yet from the Senate. So what I would normally say in a typical kind of following along Congress year is that we'll get something from the House, we'll get something from the Senate, and we'll wait until we see what each of those say before we get into the nitty-gritty of planning. But as we get closer and closer to the end of the year here, we still don't have anything from the Senate. So we'll take what we have from the House and build from that. But it's important to remember that the Senate hasn't given us their proposals yet. They will be different, I'm sure, in some ways, whether they be big or small, we'll wait to see, but they'll be different in some ways than what we have here from the House. We mentioned that this is a kind of a pay-for item. These proposals are meant to provide and estimated to provide 2.1, I've heard 2 trillion, $2.2 trillion of revenue raisers to help fund the Build Back Better Act, the reconciliation bill we're talking about. So one point of just clarification before we move to what it looks like to get this into an actual tax law. Don't confuse the Build Back Better Act with another piece of legislation that's currently kind of stuck in Congress. That's the infrastructure bill, right? The Infrastructure Investment and Jobs Act. That was a piece of legislation put together in the Senate by a group of bipartisan senators and passed through the Senate on a bipartisan basis back on August 10th of this year. It is stuck right now in the House of Representatives. And for our purposes, there's not much to it. From a tax planning perspective, there's a few minor tax provisions in there around cryptocurrency and a couple of other things, but there's not a lot to it that we need to dissect from a tax planning perspective. But it's gotten itself kind of strung into what we've got going on with this reconciliation bill, in that the House of Representatives was given the Senate's version of the infrastructure bill back in August, and has held on to it there, unwilling to vote on it until they have the broad parameters of what this reconciliation bill will look like. So remember, the infrastructure bill was a bipartisan piece of legislation that has just a number of pieces of spending for infrastructure that both Democrats and Republicans could agree on, while they held back all of the other things that are on the Democratic agenda for this bigger reconciliation bill that only Democrats will be supporting, right? So as we talk through this reconciliation bill, all of the debate that we currently have is on the Democratic side. The Republicans are fairly well unified in that they do not support this level of spending. They're sitting this one out. Everything to be decided is still to be decided on the Democratic side, okay? So that's kind of the nuance between that bill that has been passed through the Senate and now our reconciliation bill. So let's look at what's got to happen to go from the proposals we're going to talk about today to the end of the year when we actually get a bill that we think would be passed through Congress and signed by the president. Okay, and let's pause here for just a second to make sure I say this piece, which is I am not a political pundit in any way. Taxes and Congress, of course, they cross over a lot. But my objective here today is not to give you any sort of insight into what is a good idea or a bad idea, what will work or will not work. My commentary is just based on what's there, what we should start planning for. I'll leave it to all the channels on TV to tell you what you should and shouldn't be happy about within these bills. So let's just focus in on what we have and what we can start planning for from a tax perspective. So the path for legislation, there's a lot of hurdles in place between where we are today and what would have to happen for an actual law to be put into place, signed by the president before the end of the year. First and foremost in that, kind of the first hurdle is the size of the reconciliation bill, how much spending we're going to authorize. When they built the framework of the reconciliation, the Senate allowed for $3.5 trillion of spending on the initiatives that the Democrats want to take up. That doesn't sit well with everybody. So specifically, Senators Manchin from West Virginia and Senator Kristen Sinema from Arizona have voiced their opposition to a price tag of $3.5 trillion. Manchin has said at some points that $1.5 trillion, $1.5 trillion would be something that he could support, although it's hard to tell whether that was a guarantee of his support or just kind of talking out loud. During this process, as they've debated the prospective size of the spending bill, the administration has encouraged the Senate to try to come down to something more like a $2 trillion spending package, but it's still unclear whether Manchin and Sinema would support $2 trillion either. So that's kind of there's a big piece there that we're still working through. And while we're considering lowering the overall spending price on the bill, we also have to consider that folks like Bernie Sanders are still pushing for a $3.5 trillion package, pushing to not compromise at all on what it is the Democratic agenda wants to accomplish, and putting it all into a bill, taking this opportunity to go all in on it and not kind of compromise on what they want to be able to do. So the spending portion of it, that obviously has a lot of impact on the debate and when this actually gets passed. But from a tax perspective, what that does is if the overall size of the spending package changes, it lends to reason that the revenue raisers, the tax increases, would also change. So if we move from a $3.5 trillion price tag to something more like $1.5 million, then what we just talked about on the last slide, the $2 trillion of revenue raisers from tax increases, well, you wouldn't need $2 trillion of revenue raises if only $1.5 trillion is to be spent as a part of this bill. So while all the impacts of the spending are something that we're not talking about today, that does have an impact on the revenue raisers, which of the tax provisions would be included if the price tag comes down. I would think, and most people would expect, as we move into an election year next year in Congress, the Democrats wouldn't want to place more tax burdens, raise taxes on more people than they have to in order to get this bill through and accomplish their goals. So one other piece as we talk about how we get from what's out there today to what could be signed, if we agree that the cost of the bill has to be brought down in order to get all of the senators on the same page, where is it politically appropriate to cut or trim back the aims of an ambitious piece of legislation? So the bill is meant to have impacts in the areas of healthcare and family leave and energy provisions, low-income tax credits, climate change, et cetera, et cetera. Where do they find the funding to pull back on to cut some portion of that $3.5 trillion price tag down? And who gets on board with that then? So there's the Senate to consider, there's the House to consider, where progressives and more conservative Democrats may not always line up on the same page. And if they even agree that the price tag has to come down, how do you go about doing that? Where do you cut? Some have proposed, well, let's keep every item in our agenda that would cost us $3.5 trillion if we did it all the way, but just stop short of going all the way. We keep all of the different provisions that we want, but we either put them in for a shorter spending time span or put a little bit less money toward all of them, but we want every different initiative to be included. Others would say, let's take away some of the initiatives that we want to implement, but do them all the way. Have them go for the full time period we've proposed, or give them all of the money that we've proposed, but cut out some of the initiatives themselves. So even if you can agree that the price tag should be X, what is it that we're going to cut to get to that point? That's still a point of contention too. And then I make mention down here on the end of this slide that the Senate still hasn't given us its tax provisions yet. So what that means is that when the Senate comes out with what it would propose, we have to take what will obviously and certainly be something a little bit different than what the House has proposed. Each of those bills will have to then be put together through the Joint Committee of Taxation and reconciled into something that both sides are happy with. And if this sounds familiar, we went through the same exercise 4 years ago when the Tax Cuts and Jobs Act got signed by President Trump on December 27th of 2017. Okay, if you recall, when the 2016 election happened, President Trump was installed in 2017 in January. From January until about September of 2017, the debate was all about the Affordable Care Act, whether or not to repeal and replace the Affordable Care Act. If you remember, John McCain did his famous thumbs down on the Senate floor to vote down that bill. Then in September of 2017, that's where we made the hard pivot toward tax law reform, and they sped through from September to December of that year through reforming the tax code, and that ended up signed by President Trump in December of 2017. But same process was followed there. The House had a bill on the floor, the Senate had a bill. They both approved their own bills to the Joint Committee on Taxation to reconcile the two bills. Once those are reconciled into something that both are happy with, it goes back to each House of Congress. They both have to approve it again before that final reconciled bill can go to the president's desk for signature. So there's a lot of steps and a lot of hurdles here before what we're going to talk about today has a chance at being made a permanent law signed by the president. So not only do we have those hurdles, debates that are still happening, and then kind of procedural things that happen, but of course, even as we're contemplating a change in tax law, there are other pieces of the world that keep spinning that they're going to have to consider. So some of the timing check marks that we'll look at between now and the end of the year. Number one, there's a highway authorization bill that runs out as of October 31st, so the end of this month. Surely that would be taken care of by passage of the infrastructure bill that we mentioned earlier is stuck within the House. But that infrastructure bill has gotten kind of tied in through all the negotiations with our tax bill here. So we need to see progress move on both of those fronts by the end of this month in order to re-up the highway bill. The second piece of that I think about is, if you remember, right at the end of September, we were facing a government shutdown if we didn't fund the government further through a spending bill. We did that the night before the government shutdown. So September 30th, we got that spending bill put together, but we only extended the government's funding through December 3rd. So by December 3rd, we have to retake up that debate to fund the government beyond that point or face another shutdown. Tied into that, if you remember, we put a marker of October 18th on as the date that the government would run out of money, and then we would start defaulting on our debts unless we raised the debt ceiling. So if you recall, we did that earlier in October. We raised the debt ceiling, but again, only for a couple of months. So current projections are that we have enough money to continue paying our obligations through the end of the year, but right about the 1st of 2022, we would run out of money and again face defaulting on our debts. That's an important piece of all of this too, as we talk about raising the debt ceiling, spending more. What is the price tag of this legislation? How does that all tie in together? How does it impact the debate? The last piece that I'll mention there is something that we come to every year as we get to the end of the year, and there's provisions of the tax code being decided. December 31st is the expiration date of a number of different tax provisions, right? There's extenders, as we call them, that happen that kind of get extended at the end of every year. The expiration of the expanded child tax credit, as well as a number of other provisions, those all expire on December 31st. And it's nice to have a new idea of what tax provisions are in place going into next year before we get to the end of this year. So all of those things go into the debate and the process of how we get from what's proposed today to what might actually become law. It's a lot to do, and Congress has that in front of them. We're in the very uncomfortable position, I would say, of waiting for Congress to act. So that brings us to our first poll question. These poll questions will not have an answer which I know is right or wrong. I'm just curious to see what everyone says. So our first one here, the United States national debt is nearing 29 trillion. We'll be there soon. Does that matter? Does it matter how big the debt has gotten? Our choices here, yes, of course it matters. No, not really. C, I'm not sure if it does or it doesn't. And then finally, D is the debt doesn't matter, but the interest payments on the debt certainly do matter. So again, I don't know what the right answer to that is. It's something that fascinates me, whether it does or it doesn't. Curious to hear responses of the group here today. Those responses will take a bit of time to get back to me, so we'll keep going here. We may come back to that in a minute, though. So now that we understand where we are and what the path of this legislation is, let's dive into what it actually says and see what we can start thinking about and planning for, okay? So let's start with what's proposed from a business tax perspective. Obviously, the headline in the business tax changes is the change in the corporate tax rate, right? So if you remember, the Tax Cuts and Jobs Act back in 2017 gave us a tax rate reduction for corporations from 35% all the way down to 21%. What's being proposed here is that we take the top rate, we put in a graduated rate system again, and the top rate moved from 21% up to 26.5%. So what it says is the first $400,000 earned taxable for a C corporation, just C corps, would be taxed at 18%, a little bit lower than what we've had. From 400,000 to 5 million of taxable income, that would be taxed at 21%, like we've seen over the last 4 years. Anything above 5 million would be taxed at 26.5%. So moving the top tax rate up. Also important to know that the top tax rate would apply without any graduated tax rates for corporations that have more than 10 million. So if your total income taxable is more than 10 million, no graduated tax rates would apply, just at the 26.5% mark. Okay. The second bullet point down here is something interesting to consider. When we went through the Tax Cuts and Jobs Act a few years ago, we put a provision in there as a revenue raiser to offset some of the spending on tax decreases back then, that private equity carried interest would have to have a 3-year holding period rather than 1 year in order to get long-term capital gain treatment at lower tax rates. There's provisions here in this proposal that would extend that out to 5 years, and also some smaller items that would help close up some of the loopholes to get around the 5-year hold. So 5 years instead of 3 years for carried interest treatment. And then this next item I think is pretty interesting. So qualified small business stock, which is set up through Section 1202, offers exclusions on capital gain to holders that qualify for the 1202 treatment. And as of, I think it's just September 28th of 2010, any qualified small business stock that qualifies for this treatment that you've acquired or purchased since September of 2010 is eligible for 100% exclusion up to a cap of $10 million. So that means when you sell qualified small business stock and you report your capital gain, all of the gain is excluded from tax. There's a small period before that time in 2010 where 75% of it is excluded. Previous to that, the exclusion was 50%. What's proposed in this bill is for anyone whose taxable income, or rather adjusted gross income, is over and above $400,000, that the 75 and 100% exclusion rates would no longer apply. 50% would be the cap. So there's a lot of folks that did a lot of great planning back in 2008, 9, 10, and on, that planned for their stock to be qualified under 1202 treatment so that they could get 100% exclusion on the capital gain at the point they sold it. That would get moved back to 50%. 50% is still good, it's still there, it's just not the kind of tax provision that was in play at the time you made those plans. So 50% would be the maximum there. And I'll mention this here just as a disclaimer. There are many international tax changes that are included in this proposal that will impact businesses with overseas earnings. An international tax session is best left to itself with an expert in international taxes. We're not going to touch on that today, other than to say there is a lot there in this bill for international tax reform. Enough that it probably warrants its own session. In this hour today, we won't have time other than to mention that that's something that folks need to look into if international taxes are something that hits you. Okay. One thing that didn't make the slide that I think I'll just mention quickly, there is a provision here that has been discussed before but has been put off that would accelerate into 2022, and that is the limit on deductions for executive pay of $1 million per executive for public companies. So a public company would have its deduction for compensation income to executives limited to $1 million for certain executives. That's something that's been included in previous tax laws, but postponed. It would come back here under this law. This is also a good place to note that there are 3 different dates, 3 different dates that are impactful in this law. The most important one, obviously, most of these provisions that we talk about are scheduled to start as of 1/1/2022. So this next coming tax year, that's when the corporate tax rate would change up to a max of 26.5%, and most of the other provisions would change. Impacts to this 1202 stock that I mentioned, the limitation being 50, or the exclusion being 50% limited rather than 100%, that would take effect as it's proposed right now as of September 13th of 2021. So that's the date that the bill was introduced, that the proposals were put out to the public. That would be the date at which any 1202 stock, we would decide whether it goes under the old rules or the new rules. We'll see that again in just a minute, and that's an impactful date. The third date we'll come to a little bit later in the presentation, but let's keep moving here. So some of our proposed individual tax changes. the kind of the highlight here is the marginal tax rate for individuals would move up from 37, where we set it 4 years ago. It should say here 39.6 would be our new top tax bracket. Not only would 39.6 be reinstated as our top tax rate, but the marginal tax brackets would sort of shrink so that we got to a married filing joint couple would get to the top tax bracket at 450,000 of income. Currently, it's at about 630,000. So while none of the other tax rates would change, just the 37% bracket goes up to 39. The 32 and 35% brackets that come before that top bracket would be shrunk as far as who qualifies for them, such that you move to the top tax bracket sooner. Not only are we changing the top tax rate for ordinary income, we're also changing the top rate for qualified dividends and capital gains, long-term capital gains. What had been 20% as a maximum tax rate there would move up to 25%. And again, this is another place where the date that this bill was introduced or the proposals were made public would be the date of change for the 20 to 25% tax rate change. Now, I'm going to give an opinion here, and it's just an opinion, so take that for what it's worth. But, and it honestly, it may be rooted in some sort of hope. But I think that by the end of the year, when this bill actually gets put together with the Senate version, debated and signed by the president, that we'll move the 9/13 date back to the end of the year. I mentioned some of that might just be hopeful. As a tax advisor and a tax preparer doing tax returns, I would really rather not have to figure out from everyone's portfolio when you sold each piece of stock that you sold during the year and bifurcate it between what came before 9/13 to apply a 20% tax rate and what came after 9/13 to apply a 25% tax rate. That sounds like a lot more work on my end. I'd rather not have to do that. I'm hopeful that the AICPA makes Congress aware of that before we get to the end of the year and we move that back. So I still think that there's some opportunity if you have capital gains that you're considering triggering before the end of the year, that there's still some opportunity to have that done now, even though as proposed, we are in the period in which the rate has already been increased if this is passed. But if they move that back, they negotiate it toward the end of the year, there's still some time here to trigger capital gains at the lower tax rate. Hopefully. Of course, we talk about 25% as the new tax rate for long-term capital gains for qualified dividends. We are still adding to that the 3.8% net investment income tax. That's the tax that started in 2014. It helps fund Medicare spending and through the Affordable Care Act. That's still in existence. So really your long-term capital gain and qualified dividend rate moves up to 28.8% through that. But it also expands the net investment income tax, which up to this point has only included passive income. Investment income has not included the active trader business income of people active in their businesses. This would expand the net investment income tax to include such things like S corporation income that flows through to individuals for those that have more than 500,000 of adjusted gross income. But not only that, we're not quite done yet. We're also going to add an additional surtax of 3% to individuals whose adjusted gross income exceeds $5 million and to trusts with non-distributed income of $100,000. Notable in that, not just that there's a 3% surtax being added on at those levels of income, but the threshold there that says 5 million of adjusted gross income, because it's AGI, and not taxable income, meaning deductions don't come into play before you consider whether or not this 3% applies to you. We're not able to sort of plan around that with deductions, with either the QBI, qualified business income deduction, or with the charitable deduction. So giving money away to charity doesn't reduce your consideration of whether this new 3% surtax applies. That's a big deal. One area to just mention here as we talk about a new surtax, and especially with trusts, that would apply, I said, to trusts with non-distributed income of $100,000. It's always been important in tax planning to look at complex trusts before we get to the end of the year to understand whether there's tax advantage to distributing out to the beneficiaries of the trust to help lessen the burden of the trust from a tax perspective. It will become even more important now to try to understand whether it's better to distribute funds out of the trust, leaving less than $100,000, or keeping the funds inside the trust, having the trust pay the tax. There may be some scenarios which making distributions out to the beneficiaries will certainly help from a tax planning perspective. So let's click through here. I think we've got our next poll question. And this one is another one that's sort of timely right now. So in August of this year, 2.9% of the entire US labor market quit their jobs, leading economists to coin the period the Great Resignation. Are you looking to change employers? We've got here, yes, I'm currently looking to make a change. No, I'm happy where I am, maybe in the future, but I'm settled for now. Or D, this doesn't apply to me, I'm retired, self-employed, something else. So curious, we're not reporting back to employers. If your answer is A, your employer is not going to know that, of course, so feel free to respond as you want. And this is probably a good time to come back to our last poll question. I've got the results here now, and it's pretty well lopsided. 83% of us thought, yes, of course, the size of the national debt matters. Just 4% thought that it did not. And some of us are not sure still, of course. You know, I said that I find the debt to be fascinating. I really do. I was actually on vacation with friends at a beach house. This was last summer. And as we normally do, we take our drinks out on the porch for the evening and sit and muse about the things going on in the world. And it's not a very fun group, as you can tell. So we talked about the debt ceiling for a while and the national debt. And I came up with this scenario, and this is something that I think about. Let's say I was going to run for president right now. I'm going to run for president, and my entire campaign is based around the fact that I'm going to balance our budget and pay down our national debt. I'm uncomfortable with the debt, as 83% of us on this webinar are right now, and I want to pay it down. So I'm not only going to balance our budget, but I'm going to create a surplus, let's say a $500 billion a year that we're going to use to pay down our debt incrementally. So I'm going to raise revenues, I'm going to lower costs. I'm going to do that to a point that we eliminate our $1 trillion plus debt that we take on every year. And even beyond that, I'm going to go to $500,000 or $500 billion of surplus to pay down our debt. I don't know that I'd get any votes as of today. I don't know that anybody would vote for that. But in order to pay off our debt with the size that it is now, not only would I have to do that, win the presidency and actually have that happen, but the next 15 presidential terms would have to do the exact same thing. So even if we assume that everybody's we have popular presidents that get 2 terms apiece, the next 8 presidents would all have to adhere to the same model before we paid off our national debt. If you think about that, that's going from Kennedy to Trump, all with one goal in mind of paying down our debt. Now, I don't know that zero national debt is something that any of us are aspiring to. It may not be important. There are certainly economists that say that the national debt is not something we need to be looking at, but that's the size that we've gotten to, and just something that I mentioned I find fascinating. Let's leave that where it is for now. But this poll question looks like responses are into me. Almost half of us happy right where we are. A third of us may be looking in the future, but settled for now. As we think about the labor market and the Great Resignation, of course, what we have in these spending bills will impact people's intention to work and companies' ability to pay workers. And so it all kind of intertwines here, which is why I asked for that one. That's interesting. Let's leave that aside and go back to our tax provisions now. If we click forward. So a few more individual tax provisions that let's consider before we move ahead. The top one on this page is a really interesting one. So if we go back to 2017, when we passed the Tax Cuts and Jobs Act, the big headline in that bill was removing the corporate tax rate down from 35 down to 21%. And at some point late in the negotiations of that bill, as it was getting close to passing, a number of senators, including a Tennessee Senator Bob Corker, said, wait a minute, the corporate rate's coming down, but the vast majority of businesses in the United States are not corporations. So what happens to all the partnerships and to the S corporations that don't pay taxes themselves, but rather flow the income through to the individual owners of that business to have them pay individual taxes? What about the tax rate for those folks? So what they came up with was this Section 199A qualified business income deduction. It allows for a deduction of up to 20% of your income coming from those flow-through entities, from S corporations and from partnerships. Certain things apply, certain things don't, but for the most part, it's a 20% deduction. The only parameters put around that was that you either had to have property that you owned that was being put to work to create your income, or you had to have wage expenses, AKA you had to have people working to create that income. So as long as you had enough property within your business or enough wages that you were paying to people, you qualified for the full 20%. And there was no cap on it. So if I had a $10 million profit from my partnership, and every year that $10 million is being reported on my personal income tax return, well, I get a deduction then, assuming I qualify for it, of $2 million. So a $10 million profit, a 20% deduction at $2 million. What they've proposed here is to cap that deduction at just $500,000. Essentially, what we did when we made the 199A deduction was we took the top personal tax rate of 37%. We offered 20% deduction on that income. In effect, it lowered the tax rate down to 29.6 for individuals that fall under this scenario. If we cap the deduction at just $500,000, we take away that tax break to a large extent for the highest level taxpayers. But that's something that's interesting that existed only in the last 4 years that we're already starting to walk back. Another piece of the legislation back in 2017, another revenue raiser in order to offset some of the tax reductions that were in place, was what's here called the excess business loss, a limitation of $500,000. So in the same scenario where we have flow through income from partnerships, from S corporations coming to me, the maximum I could deduct on my tax return as a result of losses from those businesses was $500,000. If I own multiple businesses, I can offset the ones that are profitable with the ones that have losses, but only to the extent that I have a maximum loss of $500,000. Any losses over and above $500,000 become a net operating loss. They're carried forward to future tax years. They're treated as an NOL, and I get to take them in pieces following the NOL rules. Well, when that passed in 2017, it stayed in existence for the 2018 tax year. And then in March of 2020, when the CARES Act was passed, as Congress was trying to make improvements to the economy and give us a leg up, we suspended the excess business loss limitation rules for 2019, 20, and 21. What this proposes to do is to put those back into place starting in 2022 and make them permanent going forward, whereas they were set to expire in 2026. So another piece of limitation of the losses that you're allowed to take. So those are the major individual income tax provisions that are included here. The rest that I have on this page are estate tax related. Again, we haven't been able to get to every single one of the 40 different provisions. There are a lot of other individual income tax provisions, but those are some of the highlighted ones. So let's talk about what's there in the estate tax provision for a minute. So the first item there, and the one that's the big headline from an estate planning perspective, is that in 2017, when we doubled the exemption for the estate tax from 5 million up to 10 million index for inflation, we're going to go back to the pre-Tax Cuts and Jobs Act amount. So right now, as it stands, each individual taxpayer in the United States has an estate of up to 11.7 million. That's the current exclusion, 11.7 million that you can pass on at your death to your heirs tax-free. Over and above that 11.7 million, there's a tax on estates of up to 40%. But 11.7 million is what you can pass on tax-free. Married couples can combine their exemptions to $23.4 million then tax-free. What this proposes is that we go backwards. The 2022 exclusion would then be 6,020,000. So let's round that down to 6 million. So from 11.7 million down to 6 million. So anything over and above 6 million, you would be taxed at up to 40% on your estate at passing. So that gives us an opportunity here before the end of the year to try to implement some strategies for estate planning that moves money out of your estate, especially if you're in a position that your estate is beyond the 6 million, or if we combine that with your spouse $12 million estate, we want to be able to move money out before the end of the year and they take away some of our exemption. It's important to note there that if you give money away into a trust, or specifically to your beneficiaries, to your heirs, before they lower the exemption, the gifts that you make before the time the exemption is lowered do not count against you when you get to the point of your passing. So if we give away 11.7 million while the exemption is 11.7, when they knock it down to 6, that doesn't count against us. That's not clawed back. Okay, so all of the giving up to 11.7 million is still good and moved out of your estate by the time you get to your passing. Okay, that's what gives us the opportunity for planning now. Another piece here that's important, the next line item on the slide, exclusion of the assets in grantor trust, or inclusion rather, of grantor trust assets back into the decedent's estate. So right now, if I pass money, make gifts during my lifetime over to grantor trusts, which are the most commonly used vehicle for making gifts, all of that wealth is outside of my estate. I've moved my $11.7 million out of my name into the name of my grantor trust. That's no longer included in my estate. I can do that tax-free, free of gifts, free of gift tax, and free of estate tax. What this proposes to do is to take all of the funding in a grantor trust created after the date of the enactment of this law and include that again back into your estate. Okay, so there's the third time frame. We said 3 dates that are important. One was the first day of 2022, when most of these provisions will take place. The second one was 9/13/2021, when the capital gains rate would change as proposed here. The third one is the date of enactment. That's the date that this is signed by the president. That's the date by which all grantor trusts created or funded after that date would not count as moving out of your estate. So not only would the assets in that grantor trust be considered still a part of your taxable estate, but any transactions between you as a grantor and your grantor trust would become taxable transactions. So as of today, a common item is to make loans to a grantor trust, to allow a trust to invest money, grow its wealth outside of our estate, and then pay payments back to me as the grantor of loan interest and principal. As of today, none of that is a taxable transaction. The trust can make payments to me without incurring any sort of tax. I don't have to pay tax on the interest income I earn on the loan to my trust. The trust can invest the assets, make plenty of money. The interest rate that it pays back to me is far lower than the rate that they're getting on the assets. It's a good planning tool to let the assets outside of your estate grow. Any new loans made to grantor trust after the date of the enactment of this bill will become taxable transactions, meaning a loan payment back to me with an interest component would become taxable income to me. Now, we've long thought of a grantor trust kind of being another pocket, right? I have assets in my estate, I have assets in the grantor trust. It's all meant to be for me and my heirs. I can pass money between them from a loan perspective, or selling assets from this entity to the trust, but that becomes taxable under this law. What that essentially does, I think, in effect, it would reduce any reason to have a grantor type trust, which we've long used beyond the enactment of this law. Grantor trusts in place before the date that this law takes place, before it's enacted, will be grandfathered into the old treatment. So any trust that you have now that's grantor, that's in place and funded prior to this bill taking place, that's still good. It's outside of your estate. The laws on that don't change. Loan payments for loans coming back to you from those grantor trusts that were in place prior to the enactment of this bill, those are still non-taxable transactions. So there's another place for planning for us. The last item here that's really important to mention from an estate planning perspective, we have long used valuation discounts as a tool to be able to pass wealth over to our heirs, to trusts, to other folks, without using all of our lifetime exemption or being hit with the estate tax. Let's give a scenario here. I have $10 million worth of assets that I'd like to pass along to my heirs, and I'd like to move those out of my estate now so that they can keep growing and growing and growing without incurring any more estate exemption hit or any estate tax. So rather than take that $10 million worth of assets and placing it into trust for my heirs, what I can do is place those assets into a family limited partnership. And instead of giving the assets themselves to my heirs or to trust for their benefit, I give a partnership interest in the partnership to a trust for the benefit of my heirs. When we do that, the IRS has allowed for a long time a discount on the value of what it is that you're passing to your heirs. So the discounts are available for a lack of marketability, right? Your heirs won't be able to go sell this partnership interest on the open market. It's a family partnership. And also a lack of control. If we're passing to them less than a 50% interest and with non-voting rights, they don't have control over this partnership. So those are two areas that we can take a discount on the value of the partnership interest. And that often ranges from 25 to almost 40%. So in my scenario where I'm putting $10 million into a family limited partnership, and then let's say giving 10% partnership interest to one of my heirs, it stands to reason that $10 million of value in the partnership, 10% interest being $1 million of value. But as far as what that does to my estate tax exemption, I'm only using something between $600,000 and $750,000 of exemption to be able to pass that $1 million of value over to a trust for the benefit of my children or grandchildren. This bill proposes, as has been talked about for a long time, eliminating those valuation discounts for non-business assets. So if I'm doing this with cash, if I'm doing this with marketable securities, I wouldn't be able to take those discounts. If we're being honest, we probably couldn't defend the use of those discounts as it were anyway, but it's something we've been able to take advantage of within the tax law up to this point. This proposes to take that away. So if we click over, now that we understand the provisions that are there, which ones are not there? I think it's worth just a couple of minutes to talk about what has been proposed just kind of out loud in the past that didn't make it into the proposal that the House has given us here. Okay, so during the campaign during 2020 and since then, there have been a number of things. One of those is a tax on the wealth of the ultra rich, right? So the wealth tax, that's something pushed by Bernie Sanders, by Elizabeth Warren, both in the Senate, a tax of whatever would be 2 to 3% on the ultra wealthy. Those are folks that I think they've used different cuts of 10 million, 50 million, 500 million would have different wealth taxes associated with them. Essentially, add up the fair market value of everything you own on an annual basis and pay a tax on your overall wealth. That's not included in this bill. The administration of such a tax, I have to imagine, would be somewhat of a burden, certainly, and a nightmare from the IRS's perspective to try to enforce. So that's not included here. Something else not included is the elimination of stepped up basis at death. So as of now, when you pass away, all of the assets that are included in your estate and passing to your heirs, no matter what your tax basis was in them, we're stepping up your tax basis up to the fair market value of the asset at the time of your passing. What that essentially means is your heirs take the asset then, and it has no kind of built-in tax associated with it. There's no capital gain if they were to sell that asset the same day as they're receiving it, because their basis is the same. Again, that's something that if we were to strip out, if stepped up tax basis was to be removed from the tax code, I think the administrative nightmare of getting the tax basis of every asset owned by individuals and families for as long as they've owned it would be a tough piece. And of course, the farming industry, as families have farms that pass from generation to generation to generation, the tax basis of farming, that's certainly something that gets hit a lot in the political discussions there. We didn't touch the state and local tax deduction limit. That's a limit that was placed back in 2017. A maximum of $10,000 is all you can deduct from state and local taxes, no matter how much you pay. Democrats in California, in New York, and New Jersey, other high tax states have been pushing for that to be removed to be able to deduct more than $10,000, but that's not included here, though House representatives have said they'd like to take that up in a future bill. And then at the bottom here, taxing capital gains as ordinary income for certain taxpayers, that's also not included here. There's been different ideas of moving the cap gains rate up to the ordinary income tax rate if you're a taxpayer with more than $1 million, or putting in other provisions where your portfolio is marked up to its market value, and even unrealized gains are subject to taxation. None of those ideas have hit into this proposal here. So a number of wins there from a perspective of the high wealth. All that to say, we don't have the Senate provision yet. So we don't yet know, some of these things may be yet included in what Ron Wyden, who is the chairman of the Senate Finance Committee, who writes tax law in the Senate. We may have more provisions that include some of this there, but we wait to see for Congress. That gets us to our third poll question. Considering the proposed tax changes that we have talked about so far, which of the following do you expect will have the most significant impact on you? We've got raising the corporate tax rate, raising the personal income and capital gains rate, limiting the Section 199A deduction, if there's a provision that is not listed in those three, or if you're in the position down at the bottom, you don't expect any of the changes to impact you. So give your response there to that poll question so we make sure we get credit for the session. And with the few minutes we have left, I thought we would take some time to consider what planning considerations we should be making now. Again, we don't have a law that we know that we can bank on will be passed, but we have some considerations here to make. So what should we be thinking through? And I'll make the caveat here, always discuss these things with your CPA or your tax advisor or wealth advisor before making any moves. There are nuances abound to all these things, and to consider each and every piece of your personal situation is important before you make any moves from a tax perspective. But what should we be thinking about as we go back to our tax accountants? What should we be talking about? The first bullet there is accelerating ordinary income and long-term capital gains before year end. So that's kind of an obvious one. If we know we have a lower tax rate today than we expect to have tomorrow from a corporate standpoint or from an individual standpoint, should we be accelerating income or triggering capital gains before we get to year end? Worth noting again, capital gains as proposed right now, you're already in the provision where we have the increase to 25% after September 13th, but I still think there may be a chance that that gets moved back to the end of the year. So still value in considering those long-term cap gain initiations before we get to the end of the year. The second line item there we haven't talked about yet, but locking in cryptocurrency losses before year end. That doesn't apply to everybody, surely just those that have put themselves in a position to be investing through cryptocurrencies. As of right now, those cryptocurrencies are not subject to the wash sale rules. What the wash sale rules say is when you have an asset, let's say a piece of Apple stock that you're selling today for a loss, you can't buy that stock again for up to 30 days until at the 30-day mark, you can buy it again without that loss being postponed. So if I were to sell my Apple stock today for a $100 loss and buy it tomorrow, that loss would be suspended until I sell the stock again. I haven't given up my economic right to that asset, so I can't take the loss yet. Cryptocurrencies don't yet apply under the wash sale rules, but they would under this proposal. So if you have cryptocurrencies that you're in a loss position in, you can sell those today, buy them back tomorrow, but you've locked in your losses, something to consider. There are provisions here that allow us to convert our S corporations to partnerships without incurring any sort of tax hit. That's a somewhat complicated nuance that has different reasons for doing so, but especially if the net investment income tax is going to apply to those S Corp earnings, like we talked about before, there may be situations in which it's a good idea to take S Corps, convert them to a partnership during this window that we're able to do so without any negative tax consequences. When we think about the threshold for the surtax, that 3% surtax, if you're considering a sale of an asset that would certainly put you above the $5 million income range that the surtax would apply to, perhaps consider installment sales so that the gain is recognized over a period of time, keeping you under that surtax percentage. So if we've got an asset that we're ready to sell for $15 million, perhaps we consider having that come to us through installment payments over the next 4 years, keeping us under the $5 million AGI limitation and allowing us to avoid that surtax over time. Other certainly things to consider there as far as what you could do with the funds now versus later, the interest rates, the rate on return of the assets being held by you personally, as well as the possible tax rate going up, but something to consider. I have an item listed here: conversion of IRA, traditional IRA assets to Roth accounts before the end of the year. We haven't had time in this session to talk about the number of retirement plan provisions that are also included in this bill, but one of them is greatly limiting the ability of high wealth taxpayers or high income taxpayers to convert traditional IRA assets over to Roth accounts. Obviously, the difference being a dollar pulled out of an IRA account later during retirement is taxable income. Any dollars pulled out of Roth accounts are tax-free. But as you convert an IRA over to a Roth IRA, you're taking the tax hit all at once on your IRA assets over to a Roth. The Roth allows you to grow those funds tax-free, never having been taxed again when they come out. So it's attractive for a lot of folks, especially if you're in your 30s and your 40s, and there's still a lot of time between now and retirement to let those assets grow. Consider converting that now if it's something that's been under consideration. One, your tax rate will be lower this year than next year in a rising tax rate environment. But two, there'll be a lot of limiters placed on who can contribute or who can convert over to Roth accounts before the going forward. We mentioned before when we were talking about estate planning provisions, obviously the use of lifetime gift exemptions before the end of the year, especially if you're in the $6 million to $11.7 million range with your estate, making use of the full $11.7 million before that gets cut down at the end of the year. Funding of grantor trusts, paying insurance premiums. There's a lot of folks that have grantor trusts that hold insurance on their lifetime. Making payments to those trusts, even overfunding those trusts now for premiums that you know are coming over the next few years, is a good way to utilize your lifetime exemption now with gifts into grantor trusts before those aren't allowed. And then taking advantage of the valuation discounts that we talked about, putting money into partnerships to be able to give away partnership interests, using those discounts, which can be very, very valuable before we get to the point of enacting this bill and those go away as proposed. If those are things you're thinking about doing or that hit you well, please, by all means, get in touch with your tax advisor, with your estate planning attorney as soon as possible. I know a lot of the attorneys that we work with are doing a lot of that planning for their clients now, and the time is short, obviously, between now and a potential date of enactment when that can all be put into place. It takes some time to draft documents to understand the overall picture, so do that now. And then I put this last item in here. It's something that we did with a client a couple of weeks ago. Create liquidity in grantor trust by making loans now rather than waiting until they need the liquidity later. As we mentioned, loans that go into effect after the date of enactment of the bill become taxable transactions that we want to avoid. So we're running up on time here. I know we've got the last poll question to make sure everybody gets credit for the course today. It's one that I often ask around this time of year. With Thanksgiving right around the corner and many people gathering with family, which topic do you hope to avoid most at the dinner table this year? Avoiding the topic of taxes, of politics, global pandemics is a new entrant into that discussion, the win-loss record of your favorite football team, or all of the above. An easy question to answer there for the end of our session to make sure everyone gets credit. We're right up against the end of our time for the session here. I thought we probably would, so I don't know that we have time for questions today, but I offer my contact information here, bharrison@lbmc.com, where my phone number is listed. If we can help answer any questions beyond that, I'm happy to do so if you get into contact with me. There was a lot there today. There's a lot to unpack. There will be a lot more, I'm sure of it, by the time that the Senate gives us their ideas on what should be included in tax provisions, by the time the Joint Committee puts all of that together and we get something in front of the president to sign. But hopefully that gives us some ideas on how to start planning to plan for what may be coming and gets us prepared. So by all means, I'm happy to take questions if you get into contact with me. We'll work through what we can. But otherwise, thank you all for the opportunity to speak today. I've enjoyed it, and hopefully everyone was able to get something out of this session.